This morning in Your Money, investing versus paying off debt. Both are important, but if you don't have enough cash on hand to cover both, which one do you choose? Joining me this morning to help us out with that is Financial Certified Planner Jeff Massey. Thanks so much for being here, Jeff. Pleasure to see you as always. Now, this is a challenge that many people face. I mean, there are things you need to save for. You need to save for retirement. You need to save for, a safety net. You need to save for your education. So is it better right now to pay off debt instead, or what's the best option we should choose?
Well, what I normally tell my clients is do the math. If you have a substantial amount of debt and you have an equal amount of money in savings, and you're making 1% on your savings, but you're paying 10, 12, 14% on credit card debt, well, the math says just pay it off.
Yeah. Because
it makes more sense. And then the payments you were making to the credit card company, pay them back to yourself to rebuild your savings account.
Now, a lot of us hear the word debt and we kind of, it's not a great word, but there's actually good debt and bad debt as well, right?
Absolutely correct. So we would look at good debt as mortgage interest because you can deduct that. Brokerage or margin interest on a brokerage account is actually a tax-deductible interest. That's when you borrow money against your own funds to make an additional investment. That money is an interest that you can deduct on your taxes, so that'll save you some money. So even though like your mortgage might be 6%, but if you're in the 35% tax bracket, you get to deduct the interest. Your net cost of that 6% is under 4% because of the tax write-off. So it's not as bad.
Now, something else you stress a lot of importance to is a rainy day fund, an emergency fund. I know my family's kind of told me about that, especially for younger people. Always make sure you have a little extra money on hand just in case. Why is having an emergency fund so important?
Well, it takes the stress off life. If you have up to 6 months, and this is the most common rule of thumb, up to 6 months of living expenses in the bank, if you're still working. Now, for retirees, it's different because their income is already coming in whether they work or not. It's passive income. But more importantly, for those folks that are working, you need to have at least 6 months worth of your funds.
That's a huge number. That's a very important number, I think. If something were to happen, especially nowadays, you lose your job, to be able to still take care of yourself for 6 months while you get back on your feet.
That's exactly the point, because think of how much more calm you'll be about that. You'll be able to sleep well at night, which is a term I use all the time with my clients. You want to be able to sleep well at night. So have that emergency money built up so that if something bad happens to you, you know you can cover your expenses for 6 months. And I'm talking about the hard expenses, not the frivolous stuff.
Yeah. So what's the bottom line here altogether?
When it comes to the emergency fund, that number is going to be different for everybody because I don't know what your expenses are, you don't know what mine are, mortgage balance, etc., mortgage payments, etc., rent amount, what have you, car payments. So everybody's number is different. So you just do
mine are mostly those frivolous expenses you were talking about.
Good for you. That's great.
Jeffrey Massey, thank you so much for being here. For more information on professional financial advice, just head over to the website, foxprovidence.com.